We're talking today about how the world order is changing and how the region, the GCC region, is becoming an important region. It's very classic. It's a Renaissance state. We're now talking about a Renaissance state here that happens within this greater geopolitical and economic environment.
So, Ray Dalio, to that point, where do you see the UAE sitting on your strength relative to peak index right now? You say it's a Renaissance state. Can you elaborate on that?
I think it was summarized very well. It is a Renaissance state. What I mean is, I look for, fundamentally, do you earn more than you spend? So as you have a good income statement. Do you have a good balance sheet? Are your assets greater than your liabilities? Do you have a culture in which there's the development of people and the working together of those people to be productive? And number 4 would be, are you outside of a great power conflict? Are you in the middle of the war, or are you outside the war? And so I look at that around the world as to the places I want to invest in, the places I want to be. And this region is very, very attractive, and is at the takeoff point for the reasons that were discussed in the other sessions.
So I have a lot to ask you. I thought we could begin on one of the main forces, which is the financial angle, first of all. You're speaking to a room full of investors, capital allocators, a lot of them focused in on the region, but also around the world. So what would you say is the single most important market trend or theme that they need to be looking out for in the year ahead?
Well, the single most important market that determines all markets is the U.S. Treasury market, right? So when we think, what are interest rates? What is the value of money? It is off of that curve that everything is compared to. So now the biggest issue is that Treasury market, because we have a situation where the United States has an enormous amount of debt. Debt is one man's debts or another man's assets, and you're holding that Treasury bond. And there's likely to be a supply-demand imbalance related to that. So let me just take a second on thinking about that market. Well, you have to have a real return that's not so high that it bankrupts or hurts the debtor, without it being so low that it does not provide an adequate return to the lender. So the debtor and the creditor both have to balance. That means that you need something like, in the Treasury market, something like a 2% real return. So when you start to think about, well, what is the core inflation rate that you're going to settle on? I think it's in the vicinity of 3 to 4%, let's say. Let's call it 3.5. That means you have to have a 3.5 plus a 2 or something to bring about something like an equilibrium. So that gets you sort of where the Treasury market is and where cash is, and then we see how these events transpire. Therefore, rates are not going to come down much. Now we deal with the supply-demand question. We're still producing large amounts of deficits, which means that you have to sell a lot of bonds. The appetite for those bonds is not good for obvious reasons. First of all, those who bought the bonds are losing money in the bonds, but who are the holders? The Japanese, the Chinese, foreign buyers of those bonds. And if you take a world portfolio and you say, where is it most overweighted? It's overweighted in U.S. Treasury bonds, because we also, as a reserve currency, that's what normally we save in, the world saves in. And then there are other issues, geopolitical issues, things like sanctions. Some people worry about being sanctioned in terms of those bonds. So we have a situation in which traditional money and traditional storeholders of wealth are being questioned.